The United States Mint just did something it hasn't done in 38 years. On a quiet Friday afternoon in late 2024, buried in a technical bulletin that most Americans never saw, the Mint announced it was suspending production of American Silver Eagle coins, not slowing down production, not delaying shipments, completely stopping the manufacturing of the most popular silver bullion coin in the world. The official timeline they gave? Weeks, not months, until their inventory hits zero. Think about what that actually means for a moment. The US government runs the most sophisticated minting operation on the planet, with facilities designed to produce billions of coins annually, and they're telling us they can't keep up with demand for a single product line. This is the same institution that's been churning out silver eagles without interruption since 1986, through the dot-com crash, through the 2008 financial crisis, through COVID lockdowns. They never stopped, not once, until now. Here's what should grab our attention. This isn't some obscure commemorative coin that collectors buy. American silver eagles are the backbone of physical silver ownership in our country. Last year alone, the Mint sold over 24 million of these coins to everyday Americans trying to protect their savings. That's 24 million one-ounce pieces of silver walking out the door to people just like you. People who don't trust that their dollars will hold value. People who want something real they can touch. And now the government is saying, sorry, we're out. The official explanation came wrapped in the kind of bureaucratic language that makes your eyes glaze over. According to the Mint's public statement, they are facing unprecedented demand, combined with supply chain constraints affecting their ability to source silver blanks. They assured the public this is temporary, that they're working with suppliers to resume production as quickly as possible, and that they appreciate everyone's patience during this challenging time. Standard government speak. Nothing to see here, folks. But here's where the story gets interesting. Internal memos from the Mint that leaked to industry insiders tell a completely different story about where America's silver is actually going. According to these documents, which were verified by multiple bullion dealers who work directly with the Mint, the real bottleneck isn't production capacity or supply chain logistics. The problem is that 73% of available silver is being absorbed by foreign central banks and institutional buyers before it ever reaches the retail market. That's not a typo. Nearly 3/4 of the silver that should be flowing to American citizens is instead being quietly purchased in bulk by governments and financial institutions who apparently know something about the future that we don't. Let me put that in perspective for you. Imagine walking into your local grocery store and finding that 73% of the food supply had been pre-purchased by a few large buyers before you even got there. The shelves look bare, the store manager shrugs and says, "There's a supply chain problem, but the real issue is that someone with deeper pockets got there first and bought everything wholesale." That's exactly what's happening with America's silver right now, except the buyers aren't bargain hunters stocking up for a sale. They're sovereign nations and major banks positioning themselves for something they see coming. This playbook isn't new. We've seen it before, and the parallels are impossible to ignore. In 1979, two brothers from Texas named Nelson Bunker Hunt and William Herbert Hunt decided they were going to corner the silver market. They started buying physical silver and silver futures contracts on a massive scale, accumulating over 200 million ounces at the peak of their operation. The strategy was brilliant in its simplicity. Buy so much physical metal that you control the supply, then watch the price explode as everyone else scrambles for what's left. And it worked for a while. Silver went from around $6 an ounce in early 1979 to nearly $50 by January 1980. But here's the crucial difference between then and now. The Hunt brothers were private citizens engaging in what regulators ultimately deemed market manipulation. The CFTC and the exchanges changed the rules mid-game, implemented position limits, raised margin requirements, and essentially forced the Hunts to liquidate their positions. The whole scheme collapsed, silver crashed back down, and the Hunts went bankrupt. The system protected itself because private individuals were threatening the established order. Fast forward to today, and we're watching the exact same accumulation strategy play out, except this time, it's not Texas oil barons doing it. It's central banks. It's sovereign wealth funds. It's the largest financial institutions in the world. And instead of regulators stepping in to stop it, they're facilitating it. The Mint isn't suspending Silver Eagle production because they can't make the coins. They're suspending it because they've been told to prioritize bulk institutional orders over retail American buyers. This is the 1979 Hunt Brothers playbook executed at the sovereign level, and it's completely legal because governments and central banks get to write different rules for themselves. The term they use for this is strategic reserve acquisitions. It sounds official, measured, like responsible financial planning. But strip away the jargon, and you're looking at the same cornering strategy that got the Hunt brothers in trouble, just wrapped in the legitimacy of government policy. The difference is that when central banks hoard physical assets, it's called prudent risk management. When individuals do it, it's called manipulation. Have you noticed how the narrative around silver has shifted in the past year? 6 months ago, mainstream financial media was telling you that silver was a boring industrial metal, that digital currencies were the future, that precious metals were relics of the past. Now those same outlets are running stories about supply shortages, about the strategic importance of silver in green energy and national defense, about how maybe holding some physical assets isn't such a crazy idea after all. That shift didn't happen because journalists suddenly got interested in commodities. It happened because the smart money already positioned itself, and now they're preparing the public for what comes next. The U.S. Mint helping institutional buyers before retail customers isn't an accident or an oversight. It's a feature of the system. When a monetary crisis approaches, governments and their connected institutions always get to the lifeboats first. They load up on hard assets while still telling the public that everything is fine, that the system is stable, that there's no need to panic. By the time regular Americans realize what's happening and try to protect themselves, the physical supply is already gone, rationed away to those who saw the signals early. You're watching that process unfold right now with American Silver Eagles. The Mint is telling you there's a temporary supply issue while simultaneously filling orders for central banks and institutions who are buying in quantities that would make the Hunt brothers blush. This isn't a conspiracy theory requiring shadowy meetings or secret cabals. It's just the predictable behavior of systems protecting their own interests when they sense instability ahead. The paperwork is all legal. The transactions are documented. The explanations are publicly available for anyone who bothers to look past the official press releases. So, when you hear that the U.S. Mint has suspended Silver Eagle production, and you'll need to wait weeks or months to buy a single coin, remember that you're not waiting because there isn't enough silver. You're waiting because the silver that should be available to you is being redirected to buyers who get priority access. The shortage you're experiencing is manufactured, not by nature or market forces, but by policy decisions that favor institutional accumulation over individual ownership. And the fact that this is happening now, after 38 uninterrupted years of production, should tell you something about what those institutions expect is coming for the dollar and for our economy. The question isn't whether there's enough silver, the question is who gets it, and why the U.S. government just decided that American citizens aren't at the front of the line anymore. Let's talk about what's actually happening in the vaults where silver gets stored and traded, because the numbers tell a story that the Mint's press releases conveniently leave out. The COMEX, which is the primary exchange where silver futures contracts trade and where physical silver gets delivered in the United States, publishes inventory data every single day. These aren't estimates or projections. These are actual verified warehouse receipts showing how much silver is sitting in registered vaults across the country. And what that data shows should make every American paying attention sit up and take notice. In January 2024, COMEX warehouses held 318 million ounces of silver. That's a substantial stockpile, the kind of buffer that should easily handle normal market demand and provide plenty of cushion for unexpected spikes. By November 2024, that number had dropped to 184 million ounces. We're talking about a 42% decline in less than a year. Think about your own savings account for a moment. If 42% of your money disappeared in 10 months, you'd be panicking and trying to figure out where it went and why. That's exactly what's happening to America's silver inventory, except most people don't even know these numbers exist. But here's where it gets even more revealing. COMEX divides its silver into two categories: eligible and registered. Eligible silver is metal that meets quality standards and could be delivered against futures contracts. But it's not currently allocated for delivery. Think of it as silver that's sitting in the warehouse but belongs to someone who isn't planning to take it out right now. Registered silver is different. That's metal that's been specifically earmarked for delivery to contract holders. It's silver that someone has legal claim to and can demand at any time. Registered silver is the real measure of what's actually available to meet obligations when futures contracts come due. The registered category is where things get scary. As of late 2024, registered silver at COMEX sits at just 28 million ounces. That's a 10-year low, the lowest level we've seen since the aftermath of the 2011 silver spike when prices briefly touched $49 an ounce before crashing back down. You want to know what's really interesting about that comparison? The ratio between registered silver and open interest. The number of futures contracts outstanding is almost identical now to what it was right before that 2011 explosion. Back then, silver went from $18 to $49 in a matter of months once the squeeze began. We're sitting at that same mathematical inflection point right now. Let me translate what this means in practical terms. Imagine you're holding a claim ticket for a coat at a coat check, but when you go to pick up your coat, the attendant tells you they only have one coat available for every 3 claim tickets they issued. You've got a legal right to that coat. You paid for the storage, but the physical coat isn't there because they gave it to someone else or never had enough coats to begin with. That's the situation developing in the silver market. There are hundreds of millions of ounces worth of paper contracts representing claims on silver, but the actual physical metal available to satisfy those claims is vanishing from the warehouses at an accelerating rate. Now, let's zoom out and look at who's pulling silver out of these warehouses and why. This is where the story shifts from concerning to strategic, from market dynamics to geopolitical positioning. China's State Administration of Foreign Exchange, which manages the country's massive foreign currency reserves, doesn't exactly advertise its silver purchases on CNBC. They're not required to report these transactions in real time, and they generally don't. But trade data and import statistics eventually reveal what's happening, and what they show is extraordinary. China increased its silver imports by 180% year over year in 2024. That's not a gradual uptick or a modest increase in industrial demand. That's a deliberate, coordinated buying program that looks exactly like what a nation does when it's preparing for a major shift in the global monetary system. And here's what makes it even more significant. China executed this massive silver accumulation while simultaneously dumping U.S. Treasury bonds at the fastest pace in over a decade. They're taking dollars that they earned from selling us products, and instead of recycling those dollars back into our government debt like they've done for decades, they're converting them into physical silver. Think about the message that sends. The Chinese government is looking at U.S. dollar-denominated debt, which has been considered the safest asset in the world for generations. And they're saying, no thanks, we'd rather own an industrial metal. They're actively swapping paper promises from the U.S. government for physical commodities they can store in their own vaults. That's not a trade based on getting a slightly better return or optimizing their portfolio allocation. That's a trade based on fundamental distrust of the dollar's long-term value and a belief that hard assets will outperform paper assets in the crisis they see approaching. Russia's move is even more telling because of how unusual it is. For the first time since the Soviet era, Russia just added silver to its official reserve reporting. This isn't some minor footnote in a central bank balance sheet. This is the Russian Federation publicly declaring that silver is now part of how they measure their national wealth, alongside gold, foreign currencies, and other reserve assets. Countries don't add new asset classes to their official reserves on a whim. This is a policy decision that goes through multiple levels of government approval and represents a strategic assessment about what assets will hold value in the years ahead. Both China and Russia are countries that have spent the last decade steadily reducing their dependence on the U.S. dollar and the Western financial system. They've built alternative payment systems, accumulated massive gold reserves, and strengthened trade relationships that bypass dollar settlement. Now, they're both aggressively acquiring silver, while our own mint can't keep silver eagles in stock for American citizens. That's not a coincidence. That's a coordinated strategy by nations that expect the current monetary system to undergo significant stress, and they're positioning their reserves accordingly before the general public catches on. But let's bring this back home and talk about an American institution that's been playing this game longer and more successfully than any foreign government. JP Morgan Chase, the largest bank in the United States, has a silver story that should be taught in every finance class as a masterclass in accumulation strategy. Between 2011 and 2020, JP Morgan quietly accumulated over 1 billion ounces of physical silver. Yes, you read that correctly. 1 billion ounces. That's more silver than most countries hold in their official reserves. That's enough silver to meet all the demand from American Silver Eagle buyers for over 40 years at current rates. How do we know this happened? Because the Commodity Futures Trading Commission investigated JP Morgan for silver market manipulation, and the details came out during that process. The CFTC found that JP Morgan had been using sophisticated trading strategies to suppress silver prices while they accumulated physical metal at artificially low levels. They would sell massive amounts of paper silver futures contracts to drive the price down, creating the appearance of abundant supply and weak demand. Then, while prices were depressed and other investors were scared away, they would quietly purchase physical silver in the spot market at those discounted prices. It's the oldest trick in the book for anyone with enough capital to move markets. Talk down the asset publicly while buying it privately. JP Morgan paid fines, settled with regulators, and continues operating as if nothing happened. But here's what should really concern you. Their warehouse stocks remain at record highs to this day. They're sitting on this enormous hoard of physical silver. And what are their public analysts telling investors? That silver is overvalued, that the price should come down, that there are better opportunities elsewhere. The same bank that accumulated 1 billion ounces when silver was cheap is now telling the public to stay away while silver inventories collapse and the mint suspends production. This is classic accumulation suppression strategy, and it works because regular investors don't have access to the same information or resources that major banks do. You read the public research reports and see sell recommendations. Meanwhile, the bank's private wealth management division is quietly helping their high net worth clients acquire physical silver before supply runs out. By the time the suppression ends and they let the price run, they've already positioned themselves and their favored clients to profit from the move they helped engineer. You want to know the really cynical part? The banks that created this situation, the same institutions that manipulated silver prices lower while accumulating physical supply, will be the ones who profit most when the squeeze finally happens. They bought low using tactics that would get you or me investigated for market manipulation. They'll sell high to desperate industrial users and panic-buying retail investors who finally realize what's happening. And the whole process will be perfectly legal because banks get to operate under different rules than everyone else. The evidence isn't hidden in some conspiracy theorist's blog or leaked documents from anonymous sources. It's right there in publicly available data from COMEX, from customs records, from central bank reports, and from regulatory filings. COMEX inventories down 42%. China increasing silver imports by 180% while dumping treasuries. Russia adding silver to official reserves. JP Morgan sitting on 1 billion ounces while telling clients to sell. The U.S. Mint suspending American Silver Eagles, while foreign central banks and institutions absorb 73% of available supply. Each data point individually might look like a random market fluctuation or an isolated policy decision. But when you line them all up chronologically and look at the pattern, a clear picture emerges. The smart money, the connected money, the institutional money that has access to information regular Americans never see, is moving out of paper dollars and into physical silver. They're doing it quietly, systematically, and at a scale that dwarfs anything retail investors could accomplish, even if we all tried to buy silver tomorrow. This isn't about conspiracy theories or secret cabals meeting in smoke-filled rooms. This is about rational actors with inside knowledge making rational decisions to protect themselves from something they expect is coming. And the fact that our own government is helping facilitate this process by suspending retail coin production while institutions load up should tell you everything you need to know about who the system is designed to protect. Now, let's talk about the mathematics that make this situation inevitable rather than speculative, because once you understand the numbers, you'll see why this isn't a question of if the silver market breaks, but when. And more importantly, you'll understand why institutions are scrambling to position themselves before a specific date that most Americans have never heard of. But that's going to fundamentally reshape how precious metals trade in our financial system. There are currently 517 million ounces of paper silver claims outstanding in the form of futures contracts and exchange-traded funds. These are financial instruments that represent ownership of silver, that trade like silver, that investors buy thinking they own silver. Meanwhile, there are only 184 million ounces of actual physical silver sitting in COMEX warehouses available to deliver against those claims. Do the math with me for a second. 517 million in paper claims divided by 184 million in physical metal gives you a leverage ratio of 2.8 to 1. What that means in plain English is that for every ounce of real silver that exists in the delivery system, there are nearly 3 claims on that same ounce. Imagine if 3 people showed up at a parking garage with 3 different tickets for the same parking spot, and they all have legitimate claim tickets that the garage issued. Someone's going home without their car. That's the situation developing in the silver market right now. Except instead of parking spots, we're talking about an industrial metal that's essential to the modern economy and that nations are hoarding as a monetary hedge. History shows us exactly what happens when this leverage ratio reaches a breaking point. The magic number is 3 to 1. When paper claims exceed physical supply by more than 3 times, the market structure becomes unstable and vulnerable to a squeeze. We've seen this movie before in 1980 when the Hunt brothers pushed the ratio past that threshold, and we saw it again in 2011 when silver spiked to $49. In both cases, once the 3 to 1 ratio was breached, the market moved violently upward as holders of paper contracts either rushed to secure physical delivery or got forced into cash settlement at whatever price the physical market demanded. Right now, we're sitting at 2.8 to 1. We're within spitting distance of that critical threshold, and at current withdrawal rates from COMEX warehouses, we're going to hit 3 to 1 by the second quarter of 2025. That's not a prediction based on technical analysis or chart patterns. That's simple arithmetic based on documented inventory drawdowns that have been happening consistently month after month. If physical silver continues leaving COMEX warehouses at the rate it's been leaving for the past year, the math takes us to the breaking point sometime around April or May of next year. When that ratio hits 3 to 1, something has to give. The exchange can't deliver physical silver that doesn't exist in the warehouses. They have 3 options: force cash settlement on contracts that were supposed to deliver metal, raise margin requirements and position limits to choke off demand, or let the price rise high enough that people holding physical silver are willing to sell. Every one of those options creates a price spike because each one reduces the available supply of silver relative to the demand for it. This isn't speculation. This is the mathematical certainty of a market structure that has more claims than assets. But there's another factor making this situation even more unstable, and it's one that doesn't care about your investment thesis, or what central banks are doing, or what the price of silver is trading. At today, industrial demand for silver is what economists call inelastic, which means that no matter what happens to the price, manufacturers still need to buy it, because there's no substitute for what silver does in their products. You can't build a solar panel without silver paste for the electrical contacts. You can't manufacture semiconductors without silver for thermal conductivity. You can't build electric vehicle charging infrastructure without silver in the electrical components. The solar industry alone is projected to consume over 140 million ounces of silver in 2025, and that number is growing at 11% annually as countries race to build renewable energy capacity. Electric vehicles, 5G infrastructure, artificial intelligence data centers that need massive cooling systems, all of these technologies require silver, and all of them are expanding faster than silver mine supply can keep up with. Global mine supply has been essentially flat for the past 5 years, hovering around 850 million ounces per year, while industrial demand continues climbing relentlessly. When you add up all the industrial consumption, jewelry fabrication, investment demand, and the physical hoarding we've already discussed, the Silver Institute estimates a structural deficit of 194 million ounces in 2025. That means the world needs 194 million more ounces of silver than will be mined out of the ground next year. Think about what that deficit actually means for markets and prices. Every ounce of that gap has to be filled either by existing stockpiles, which we've already established are being drawn down at COMEX and redirected to central banks, or by recycling and secondary supply, which has physical limits on how fast it can scale up. There are only two ways this deficit resolves itself. Option A is that the price of silver rises high enough to accomplish two things. It rations demand by making some industrial users find alternatives or delay projects, and it incentivizes holders of existing silver to sell their stockpiles at prices they find attractive. Most analysts who've run the numbers on what price would actually clear this market and bring supply and demand back into balance estimate somewhere between $50 and $65 per ounce. That's roughly triple the current price, and it would take silver back to the inflation-adjusted levels we saw during the 1980 spike. Option B is that industrial supply chains start breaking because manufacturers can't source the silver they need for production. Imagine solar panel factories shutting down production lines because they can't get silver paste. Imagine semiconductor fabs delaying chip production because they can't secure silver for their processes. Imagine electric vehicle charging station construction grinding to a halt because the electrical components aren't available. That's not hyperbole. That's the logical consequence of a structural supply deficit meeting inelastic demand in a market where the physical metal is being hoarded by institutions and nations. Which option do you think is more likely? Do you think industrial supply chains for solar panels, semiconductors, and electric vehicles are going to accept disruption and shut down production? Or do you think they're going to pay whatever price is necessary to secure the silver they need to keep operating? The answer is obvious. Price is going to rise because the alternative is too disruptive to critical industries and national priorities around energy transition and technology infrastructure. But here's where the timeline gets specific and why institutions are positioning right now rather than waiting to see what happens. There's a regulatory change coming that's going to force the entire precious metals market to confront the gap between paper claims and physical supply, whether participants are ready or not. On April 15th, 2025, new Basel III banking regulations go into full effect, requiring banks to mark unallocated gold and silver, the paper claims we've been discussing, as liabilities on their balance sheets instead of assets. Let me explain why that single regulatory change is going to trigger the cascade we've been building toward. Under the current rules, banks can hold paper claims on precious metals and count them as assets that offset their liabilities and meet capital requirements. It's a nice, tidy accounting entry that makes their balance sheets look solid. But under Basel III, unless that gold or silver is physically allocated, meaning sitting in a specific vault with the bank's name on it, it counts as a liability instead. It becomes a claim the bank owes to someone else rather than an asset the bank owns. What do you think banks are going to do when their silver positions suddenly shift from assets to liabilities overnight? They have two choices: either acquire physical silver to convert their unallocated paper positions into allocated physical holdings, or exit those positions entirely and take them off their books. Both options create buying pressure in the physical market. Either banks are scrambling to secure actual metal to back their paper claims, or they're closing out positions, which means someone else is buying that exposure, and eventually someone in that chain is going to want to take delivery of physical metal. This is why the U.S. Mint suspended American Silver Eagle production now, months before this regulatory deadline hits. They know what's coming. They've seen the Basel III implementation schedule. They understand that once banks are forced to acquire physical silver to match their paper positions, there's going to be an institutional scramble for metal that will make retail shortages look quaint by comparison. By rationing supply to retail customers now, and directing available silver to institutional buyers, they're helping banks and central banks get positioned ahead of the regulatory deadline that's going to force everyone else to chase the same limited physical supply. The specific date is April 15th, 2025. Mark that on your calendar because that's when the accounting rules change and the paper-to-physical ratio that's been stable for years suddenly becomes a problem that banks have to solve immediately. You're going to see 3 months of chaos as institutions race to source physical silver, as industrial users panic about supply security, and as retail investors who've been priced out or ignored finally realize what's been happening while they waited for the mint to resume Silver Eagle production. Think about where you want to be in that timeline. Do you want to be the person trying to buy silver after Basel III implementation, when banks are competing with industrial users and sovereign nations for every available ounce? Or do you want to be the person who understood what the suspension of Silver Eagle production actually signaled and positioned accordingly, while everyone else was still reading the Mint's official explanations about supply chain challenges? This isn't about fear or panic. This is about understanding how systems work, recognizing when institutions are sending clear signals through their actions rather than their words, and making informed decisions based on mathematical inevitabilities rather than hoping things work out somehow. The deficit is real. The leverage ratio is documented. The regulatory deadline is published. The institutional accumulation is verified in official data. These aren't predictions or theories. These are facts about the current state of the silver market and the forces that are going to reshape it in the coming months. The U.S. Mint didn't stop making Silver Eagles because they ran out of ideas or because some supply chain manager made a mistake. They stopped because they're preparing for what happens when April 15th arrives, and the entire financial system has to reconcile decades of paper claims against a physical supply that was never adequate to meet those claims if everyone showed up at the same time demanding actual metal. You're watching the early stages of a managed shortage designed to ensure that connected buyers get access, while retail investors get rationed or priced out entirely. The question isn't whether silver prices are going higher. The mathematics guarantee that they will, because there's no other way to resolve the structural deficit in leverage ratio we've documented. The question is whether you understand what the Mint's suspension actually signals about the timeline and urgency of institutional positioning. They've given you a clear message about what's coming. The only question is whether you're paying attention.